Good afternoon and good morning to all, depending on where you are joining us from. Welcome to this launch of the new report guaranteeing sustainable development on the debt relief for a green and inclusive recovery project. My name is Maria Fernanda Espinosa. I am a co-chair of the project and former president of the UN General Assembly, and served as Minister of Foreign Affairs, Defense and Cultural and Natural Heritage in the government of Ecuador. It is my true pleasure to moderate this event within the next hour. Thank you to all joining us this afternoon. We will start today with a presentation of the findings of the new report on debt and climate and the DRGR proposal by the authors. And we will also hear from Ansetse Ware how debt relief and reform of the current financial architecture is perceived from African countries and the African continent. This will be, of course, followed by a Q&A session, and where we invite all of you to participate actively. You can pose your question using the Q&A section in the Zoom menu. It is also possible to ask questions of other participants so they get upvoted and will be more likely to be taken up during the discussion. If you would like to ask specific questions to specific panelists, please do include the name of the panelist when you pose the question. So before we start the presentation, I would like to quickly introduce the project. The debt relief for green and inclusive recovery, the DRGR project, is a collaboration between the Boston University Global Development Policy Center, the Heinrich Böll Stiftung, and the Center for Sustainable Finance, SOAS University of London. Utilizing rigorous research, the DRGR seeks to advance innovative solutions to address the looming debt crisis and advance a just transition to a sustainable low-carbon economy in partnership with policymakers, thought leaders, and civil society from around the world. The project is led by 7 co-chairs and an executive team. Today, 5 of us are on the panel, who I'm going to introduce very, very quickly. With us are Shamshad Akhtar, former governor of the State Bank of Pakistan and finance minister of Pakistan, myself, Kevin Gallagher, director of the Boston University Global Development Policy Center, York Haas, head of international politics at the Heinrich Böll Foundation, Yufeng Li, senior advisor of the South-South Cooperation and Development Finance at the South Center, Ulrich Volz, professor of economics and director of the Center for Sustainable Finance at SOAS University of London. And finally, Ansetse Ware, senior economic financial specialist in Africa. So I'm very pleased to present all the seven co-chairs. I'm going to, without further ado, I'm going to turn immediately to Kevin Gallagher, who is a professor of global development policy at the Fredericks Pardee School of Global Studies and director of the GDP Center at Boston University. So you have the floor, Kevin.
Thank you, Maria Fernanda. The DRGR was founded 3 years ago in the wake of the COVID-19 crisis. We have the same proposal, but in our new report, it unfortunately is justified now more than ever. Next slide, please. Some of the key findings in the new report that you can download on our webpage are that emerging market and developing country debt levels and service payments have now more than doubled since the 2008 financial crisis, reaching $3.6 trillion by the end of 2021. Climate vulnerable countries are some of the most significant of those who have debt distress. We find that higher climate vulnerability correlates with lower sovereign borrowing space and high debt service payments against exports. This couldn't come at a worse time when the cost of capital is at an all-time high and making it difficult to roll over those debts and making it difficult to mobilize new finance to have a green and an inclusive recovery. This proposal, like this report, like the previous proposals, argues for an ambitious HIPC-like debt relief scenario for the global economy. And we estimate through illustrative examples that more than $812 billion in debt needs to be restructured over all creditor classes for upwards of 60 countries, which we are calling new common framework countries, because our target reform here is a reform of the common framework at the G20. Next slide, please. It really is now or never. To the G20's credit, back in 2020, they anticipated the need for a better emergency system for sovereign debt workouts, recognizing that that's a glaring gap in the system. But it's unfortunately failing quite miserably for a number of reasons. Number one, it leaves out all the countries that are in debt distress. Countries like Suriname and Sri Lanka right now cannot participate in the common framework because they're relatively too rich. And a number of the other countries that are on the brink are also wouldn't qualify. Number two, it doesn't entice all the creditors to come to the table. Today's debt crisis involves many more actors than it did in the 1990s. We have private sector bondholders, we have domestic debt holders, and also non-Paris Club members such as China and Saudi Arabia that aren't enticed through the G20 common framework to come to the table and renegotiate. And finally, despite the fact that every G20 country is a signatory to the UN development goals and to the Paris Climate Agreement, this is not linked at all to our climate and development goals. We have to remember that it's now or never, that in between now and 2030, emerging market and developing countries need to mobilize about $2.4 trillion annually to meet their development and climate goals. $1 trillion of that has to be external in foreign currencies. We've already seen 8 countries default and many more are facing the cliff. Next slide, please. I'll quickly just go over what our proposal is. It hasn't changed since 2020. Next slide. But in this particular report, we've cost some of it out for illustrative purposes. First and foremost, we call for a reform of the IMF's debt sustainability analyses. That creates the envelope for the size of the haircut that's needed in restructurings. Unfortunately, the DSAs, as they're called, are calibrated to help countries get back on their feet at the level of suboptimal spending that they had in, say, 2019, not to be able to mobilize the resources they need for a green and inclusive recovery that's aligned with the Paris Agreement and the Sustainable Development Goals. Nor does a DSA consider external shocks like we've been having over and over again, whether it be COVID, Putin's invasion of Russia, of Ukraine, numerous climate shocks, and obviously all of these interest rate hikes. This poly crisis, as it's seen, has really been a series of external shocks that were beyond the control of emerging market and developing countries, but have had real detrimental impacts on them. So a DSA would get us to better spending needs and anticipate potential shocks and identify a number of countries that would need major debt relief and specifically how much would be needed for each country across the class of countries that would need it. Then it's pretty simple that public and multilateral creditors would take haircuts commensurate to a comparability of treatment formula, where multilateral creditors are playing a role that does not jeopardize their preferred creditor status or their AAA status. For private and commercial creditors, so say bondholders or Chinese commercial entities, there we draw on history and propose a series of carrots and sticks. On the carrot end, we propose a Brady-like bond situation where there's a guarantee fund that guarantees the new bonds that are haircutted to a certain extent. In terms of sticks, we propose lending into arrears at the IMF, a payment standstill, and some legislative fixes and executive orders that could compel the different actors to come to the table. That is the level of debt relief that's needed. But as I alluded to before, there's a third pillar of our proposal that by and large now, most of the developing world is shut out of capital markets. On average, in Africa, the spreads are about 9.44 basis points. That's unsustainable. Countries shouldn't be borrowing at that level. And so we also propose a series of credit enhancement and other measures to be able to bend down the cost of capital for those countries that don't need debt relief. And I'll just end by saying that this proposal is no substitute for a more comprehensive treaty-based workout system that is desperately needed. It's also not a one-size-fits-all fix, as we'll show you later on in this presentation, that even with HIPC-like 64% haircuts like we had in the late 1990s and early 2000s, that still only brings countries to a certain level, and they'd still have to mobilize a significant amount of more capital, which would need to be done through new liquidity such as SDRs and new capital increases at MDBs that help create new capital and concessional and grant finance that also helps bend down the cost of private sector capital. I'll hand it over to my colleague, Rishikesh Rambandari.
Great. Thank you, Kevin. So to explore the various aspects of this crisis, we took a closer look at some of the data. Could I have the next slide? And so to start with, if you look at the chart here, it shows us the composition of developing country debt stock over time. We look at 2008, 2015, and 2021. And this shows us how the composition has really changed over time. In particular, the most prominent sort of shift has been the share of bondholders, which you will see in dark blue over here. That's been the most prominent increase. Of course, the emergence of bondholders as one of the largest creditors has major implications, which we'll get into later on. But this is how the creditor landscape has been evolving over time. Next slide. Now, another aspect of this crisis is the very high cost of capital that Kevin was alluding to. For the sample that we have on the slide, the average is around 10.5%, which is a very high cost of capital and makes it very challenging for many of these countries to actually make the investments that they really need to. And it only further compounds the need for investing in climate resilience. Next slide. And so what makes this crisis especially challenging for climate vulnerable countries is that they face very tight borrowing space. This diagram here shows us the negative relationship between climate vulnerability, which we measure using ND gain index, a measure of climate vulnerability as the indicator on the x-axis, and then the sovereign borrowing space on the y-axis. And so as you can see, countries that are more climate vulnerable are more likely to have lower sovereign borrowing space. Now, of course, that means they face tight restrictions or conditions in terms of their ability to make the climate investment needs that they really need to. Next slide. And so we put together a list of countries. The total is actually 69 based on the climate vulnerable countries, or rather the countries that are at a high risk of debt distress or that immediately need debt relief according to various metrics by UNDP and IMF. And so by putting together these two lists, we came up with a total of 69 countries. 61 of those countries are countries where we have consistently available data. And so the focus of this analysis really is on the 61 countries for which we have data available. Now, because these 61 countries are ones that really need attention right now, we call these countries new common framework countries to underscore the urgency that these countries are really facing in terms of needing debt relief immediately. Now, just one more slide before I pass it over to Uli. So by looking at the composition of debt stock for these particular countries, we see that bondholders are again the most prominent at 29%. But what's slightly different for this set of countries compared to developing countries as a whole is that MDBs, the multilateral development banks, follow right after at 28% of total debt stock. And I should say that this is for 2021. China bilateral and other private creditors follow right after that at 10% each. And so as you can see, just to underscore the breakdown of creditors here where bondholders form 29%. So with that, I'll pass it over to one of our co-chairs, Uli.
Thank you, Rishi. And I'll talk a bit more about our proposal, although Kevin has already gone quite into detail. So as was mentioned, the starting point is really that we need to get debt sustainability analysis right. So we really need the IMF and the World Bank to look into the debt situation as it presents itself to finance ministries and governments. And this means that critical investment needs for climate adaptation, but also mitigation need to be accounted for. Climate risks need to be properly factored in, and also other critical spending needs for the SDGs need to be taken into account, because governments need to be able to invest in all these areas. So taking a narrow view on debt sustainability doesn't do justice. Obviously, we have to see what comes out of debt sustainability analysis to say how many countries really need a debt restructuring. But for those that need, we have two pillars. So one pillar for the public and multinational creditors, and then one for the private and commercial creditors. And it's important that we really get both to the table for negotiations on debt restructuring. Rishi just also showed how an important role actually multilateral institutions play for many countries. So this is, of course, a very touchy issue, but we do need to look at the whole set of creditors and need to make sure that they're all involved where needed. And so there should be comparable treatment. That's important. And I'll say a bit more about some measures, some carrots and sticks we have for getting the private and commercial creditors to the table, who so far have not been very involved in all the discussions over the last 3 years. We do have also a third pillar, which is for countries that won't need a full debt restructuring, but could do with more fiscal space. And here we propose different mechanisms, including debt for climate nature development swaps that can provide more fiscal space, but link that also to progressive action on development and climate. And before I say a bit more about how to involve the private sector, which was a key focus of our last major report, I would like to also emphasize that our proposal for debt relief is just one piece of a larger agenda that we need to see. So we now have finally a larger discussion about international financial architecture reform, and this is urgently needed. We do need to boost climate finance and so on, but debt relief arguably is one key piece, because there's no way that we can mobilize huge amounts of private capital if the debt problems are not addressed. Next slide, please. So ensuring private sector participation is really critical. Obviously, private creditors are not particularly keen to partake in debt restructuring and debt relief, but there's no way around it. They are so important nowadays. For most countries, they are the most important creditors. And in our proposal, we build on the experiences we've had with previous restructurings, and in particular also the debt restructurings after the Latin American debt crisis, where Brady bonds were created. And the idea is basically that private creditors trade old debt that is distressed against new debt, but at a significant haircut. And as a sweetener, they get a partial guarantee on those debt. And this is building on the Brady experience, where these debt were secured with US Treasuries. We are proposing a guarantee facility that could be hosted at the World Bank. We estimate, given the current numbers that may need restructuring, that this guarantee facility would have to be perhaps the magnitude of $37 to $62 billion, which of course is a lot of money. But this could really unlock a large-scale debt restructuring and as mentioned, the guarantee facility. So this is not money that's all going away. Much of that probably will never be needed. But we must not only look at carrots, we also need to talk about sticks. And here it's important that there are also sufficient measures taken by governments to bring creditors to the table, private creditors. So when a country asks for debt restructuring, there should be an immediate debt service suspension, which will put pressure on private creditors to join the negotiation table. The IMF should enact its lending into arrears policy, and also we need from the most important jurisdictions where private debt has been issued, which is New York and London, legislation, anti-holdout legislation, and there are some interesting things happening in this space right now. Next slide, please. So we estimate that for these new common framework countries, around $30 billion would have to be debt service payments would have to be suspended, putting pressure on private creditors. So we need a really comprehensive package of carrots and sticks. Next slide, please. One thing, so here the slide shows you that we have the present value of external debt amounting to $812 billion for these new common framework countries. But then they don't only need to service their debt, they also need to undertake critical climate investment needs, which are estimated at around $650 billion. And then we have other SDG investment needs that also add on top, around $310 billion. So these are huge amounts that need to be basically, covered by these countries. So that puts into proportion the amounts of debt relief that we have estimated are needed. So taking historic level haircuts, so basically the average haircut over the last decade for debt restructuring, we need to see $317 billion of haircuts. If we take 64% average haircut during the HIPC debt restructurings, that would add another $200 billion. But still, there is this huge gap that needs to be financed. So even with an ambitious HIPC style debt relief initiative, there would still be more than $1 trillion that would be needed for financing of climate and SDGs. So we need not just debt relief, but we also need all the other things that we've been talking about over the last year. So we need to make sure that what was supposed to be a decade of action will not become a lost decade, but that we will have debt relief and new ambitious financing initiatives that can really get us back on track to achieve the SDGs. Here you have a statement from the UN Secretary General, who's been pushing for a new Bretton Woods moment, and such a debt relief initiative, we believe, should be part of it. But of course, we need a much larger reform of the international financial system, and also work towards a proper institutionalized global debt system. With this, I'll hand over to Antsetse, who will give us a bit of an African perspective on this. Thank you.
Thank you, Uli, and thank you, everyone. I'm just going to highlight the nexus point at which most African governments are finding themselves in terms of the effects that climate change is having, not just economically, but on their fiscal and monetary policy options in space. So we're really at the nexus of this. The first is, of course, the combined macroeconomic effects of climate change are going to lower GDP at the current trajectory by about 3% in about 15 to 20 years. So it's not long from now. In terms of fiscal implications and the impact on debt and why this is extremely important, first of all, climate change is having an impact on fiscal strength and fiscal space of African governments already. And secondly, African governments are having increased planned and unplanned expenditures due to climate change. So if you look at the revenue profile that African governments are dealing with now and the impact that climate change is having, prolonged droughts and more frequent droughts, more frequent floods and extreme weather events, for example, having an impact on revenue by affecting the sectors such as agriculture, lowering export receipts that a lot of African governments get from the export of agricultural commodities, lowering the revenue that they can get from firm activity in the sector, for example, and therefore lowering both the local currency revenue generation as well as external currency generation that they're getting from key sectors. And just to bear in mind that climate change has an impact across multiple sectors. So there's a multi-sectoral exposure right now that African governments are dealing with in terms of impact on revenue. And if you look at expenditure, increased and unplanned expenditure on food imports due to extended droughts, but also extreme weather events that tend to destroy crops and livelihoods. They're having increased and massive spending in fixing infrastructure that is damaged by extreme weather events. So the combined effect is that rather than using expenditure for development or in more productive manners, African governments are increasingly finding that they're having to fix the damages of climate change and the effects thereof. As a result, what's happening on the debt side, which is why it's really important to intersect climate change and debt, is that African governments actually, because of climate change, have lower repayment capabilities in both their local currencies for their domestic creditors and foreign currencies such as USD for external creditors. More importantly, a lot of the capital-intensive investments that were made by African governments, particularly in infrastructure, the productive potential of those investments are essentially being decimated by climate change. So really from a perspective of an economist that advises a lot of African governments and sits with a lot of ministries of finance and national treasuries, but also luckily advises a lot of multilateral institutions, this DRGR proposal is really about an environment of fairness. I mean, first of all, acknowledging that African governments are already shouldering the impacts of climate change on economic resilience. And frankly, there's a real exacerbation of poverty happening because of climate change and a material increase in the difference between the potential and economic welfare of temperate regions versus more tropical regions such as Africa. Secondly, just acknowledging that African governments are already bearing the fiscal and monetary policy effects of climate change. And this actually limits their ability to respond to this crisis. But also create an environment of fairness so that African governments can be honest about the impacts that climate change is having without being penalized by the market. We're in an environment where already the African risk profile in the markets is above than I think it should be if you're looking at absolute discrete numbers, and the risk perception problem that African governments have been talking about is already there. The reality that climate change is having an impact should not exacerbate that. And I'll just close by saying that fairness should extend internally to African governments. One of the big concerns that I see certainly in African publics is that this crisis, this debt crisis and climate change crisis should not be used as an opportunity to sweep under the rug the serious issues that the continent and other countries face on fiscal accountability, and fiscal mismanagement, whether that's corruption or poor fiscal planning or fiscal inefficiencies. This crisis should not be an opportunity for that to be swept under the rug, but rather be leveraged as an opportunity to strengthen that and ensure that fiscal space is broadened and then applied to the welfare of African citizens going forward. So with that, I'll close and hand back over to you.
Thank you very, very much, Ansetse, and especially for these environmental and social justice dimension of the RGR in how it's been felt by African continent. And I think it was really wonderful, great lineup of panelists for sure. And thank you also, Kevin, Uli, Rishi, for this great overview and in all the work you have put into the report. I would like now to open the floor for questions from the audience. If you haven't posted your questions yet, please do so in the Q&A section, and make also use of the like option to upvote other questions and let us know if it's a general question or you would like to address a question to one specific panelist. Let me just go check the Q&A box. I think it's empty. And so if you allow me, I will hand over to Jörg Haas from the Heinrich Böll Foundation, perhaps to ask a question. I have a few questions myself in terms of follow-up, in terms of what needs to happen politically, the engagement we are expecting from governments, because they have for sure to take the lead into this and what comes next, of course. So Jörg, the floor is yours.
Yeah, thank you so much, Maria Fernanda. Yeah, maybe it's a little bit of the question that many will be asking, you know, what needs to happen next? There's, I think there are existing discussions about that restructuring. Kevin has at the beginning very aptly said that the common framework is not working. So the big question is, what steps needs to be taken to put us on the right track? What is the process that would lead us to the kind of fundamental reforms that we propose are actually taken? And Kevin, maybe you can just become a bit more detailed. You've been very brief at the beginning.
Well, sure. I would say that we're now, in 2 weeks, we'll be halfway through the Indian G20 presidency. And unfortunately, there hasn't been much to show for it. And it's really time for India to rise to the occasion. There'll be a number of G20 meetings in May and June where a reform of the common framework could be executed. There's now a widespread consensus that the common framework is limited. And indeed, India should be credited for playing a key role in something called the Global Sovereign Debt Roundtable, which has convened in February and again 2 weeks ago in April in Washington, which is trying to struggle with some of these issues. Immediately, given the fact that Suriname and Sri Lanka are now part of the group of countries that have defaulted, one of the first and low-hanging fruit things that they could do is just say that the common framework is open to every country in debt distress. Two, we really hope that they call on the IMF to reform its DSA, debt sustainability analysis. They did a debt sustainability analysis for Sri Lanka, but it had no mention or hint of the fact that in 2004, Sri Lanka had a tsunami that was that wiped out the economy for quite some time. DSAs need to incorporate that in there. And then, as I said, all G20 members have signed on to the Sustainable Development Goals. All G20 members have signed on to and ratified the Paris Climate Agreement. And therefore, to not have the common framework linked to our development and climate goals is a breach of their national commitments and shows a lack of leadership. India has a real chance to step up and is in a unique position to do so, and strongly encourage them to do so.
Thank you, Kevin. And yes, G20 common framework, I think something needs to happen on that front. And the DSA from the IMF, of course, there's a very much, political will and better understanding of what is happening. Let me now read out loud some of the questions that we have received. Number one, from an anonymous attendee. The question is, development banks often suggest that there is an insufficient pipeline of climate projects. How do you envisage use of proceeds being targeted? And I would call Antsetse perhaps to answer this question. Please, Antsetse.
Sure. Yeah, I mean, absolutely. It's a concern. And I addressed this in last year's, in the run-up to COP for a piece by British International Investment. The only way that is going to be dealt with in a long-term issue is to focus on the financial architecture that aggregates climate deal flow. Right now, if you look at the continent and the way climate investment is done, there's a focus on deals rather than an investment in the architecture that produces those deals. So what this proposal also will create room for is for particularly development partners to play a role in the origination, in the preparation, and I can't emphasize how important and expensive project preparation is in creating large-scale, consistent project pipeline that is green and climate friendly. I'll give an example in Kenya where we had an inaugural green bond that was extremely well subscribed to. It was a private sector green bond. But if you combine the cost of project preparation, project matching, and the cost of monitoring, reporting, and valuation, you're beginning to understand the level of investment that's required at the architecture level to produce the deals. So frankly, from a economic perspective and a business perspective, the real opportunity there is the creation of jobs, but also firm capabilities and firm activities, financial sector activities, and employment opportunities can be created by focusing on the financial architecture piece and producing the aggregation of deal flow thereafter. So what I'll do is I'll put the link of the article that I did on that. You'll also see some more of that thinking in the piece that I'm doing for the African Union and the OECD in the African Development Dynamics report. And this, the debt crisis, but also quite frankly, the climate crisis is a real opportunity for private sector and development finance to come together to start generating the level of deal flow that is possible in Africa and other continents. I hope I answered that.
Yeah, absolutely. Thank you so much, Antsetse. And believe me, having been from the government side, trying to deal with this issue, the amount of due diligence, project preparation, very cumbersome processes, and at the end of the day, it becomes almost unfeasible. So you are so right. And I see Uli's hand up. Would you like to add something on this question, Uli? And then I will go immediately to the next question.
Thank you, Maria Fernanda. Just wanted to complement that part of the discussion is also taking place in a kind of blended finance context. And I think obviously there's no shortage of investment needs in all these countries. And project preparation is a problem, but then it's even more difficult if you want to have projects that generate revenues that will satisfy commercial investors. And I think the reality is that a lot of climate projects, certainly on the adaptation side, just are very hard to do as commercial projects. So we do need kind of non-commercial investments and this kind of more traditional government investment in public goods. And not to say that this is without problems, but I think these are partly different problems because you don't need to generate the returns that the private sector would expect. Thank you.
Thank you, Uli. We have a question from Sadia Siddiqui, and it's directed to Shamshad. And the question reads, could you please give your perspective on Pakistan, especially with the commercial loans tied to CPEC, and what about MDBs like ADB that have just announced a new framework on sovereign guarantees? Does that mean, what does that mean, sorry, for Pakistan? Floor is yours, Shamshad.
Thank you, Maria. I think Pakistan is going through a very serious macroeconomic and debt crisis. However, the first thing to recognize is that Pakistan has thus far opted not to go for debt restructuring, but to their credit, they have not defaulted. There has been ample support coming from the multilateral development banks. However, with the delays in the signing of the SLA, staff level agreement of the IMF, the opportunity of having more flows come in are being delayed. The requirement of the IMF now is that Pakistan should be able to mobilize resources from bilaterals, Saudis, China, and some of the other countries to the extent that they could help meet the enormous financing gap. Pakistan is actually facing a real balance of payment and exchange crisis. Now, coming to the ADB of the World Bank, I think they have been predominantly working on the policy-based operation so that they could supplement and complement the strengthening of the FX reserves, which is what is needed. The sovereign guarantee would be extremely helpful because it will be able to leverage more funding for Pakistan. But I have to say one of the issues right now for Pakistan is at what price it's able to leverage the funding required, because we are in midst of very high interest rates and also the political risks are quite high, given that Pakistan is undergoing right now big debate about selection and constitutional warfare between the General Assembly and the Parliament and the judiciary. So I'm going to stop here.
Thank you very much, Shamshad. Next question comes from Liane Shalat. The question is, how do we reconcile the need for debt restructuring to create fiscal space, including for climate investments, with the continued push by developed countries and MDBs to provide more and more of their climate finance as debt? Wouldn't this support the call for prioritization of grant financing as a matter of climate justice, particularly for adaptation and loss and damage support? Who would like to voluntarily answer this question? Ansete? Okay,
Yeah.
Please, go ahead.
Thank you. And it's a good question. One of the broader concerns we've been having is the displacement of aid by green and climate investments generally. We're seeing a material reduction in the amount of money being allocated to non-green and climate-related bilateral support, particularly to low-income countries. This has been a trend that's been going on, is actually an issue that I think came up during the last COP. So there's one issue where we need to stop that trend. There are factors that lead to poverty, et cetera, that have nothing to do with climate and that have to do with more structural issues, whether it's an economic structure or economic injustice. That needs to be addressed. I think on the climate side and preventing that, you have to bear in mind that part of that appetite is coming from governments themselves. If you look at African governments, there's been almost a 2 to 3 decade cry of trade, not aid. And so you have to bear in mind that part of the appetite for debt is informed from the government's perspective. They want to start creating economic and financial autonomy. And that is part of what informed this accrual of debt over the past 25 years. Obviously, this has been done unsustainably, and we're now bearing the very painful effects of that. So that needs to be handled in a very delicate manner that doesn't is not viewed as patronizing or reducing African governments or low-income countries to always being in the beggar's bowl, but rather acknowledging that there is an ambition and an aspiration for economic and financial autonomy and strength. And there is an opportunity for bilateral support to be better applied towards the economic ambitions of those countries. So that's one part of the question. But absolutely, the issue of the displacement of aid is one thing that does need to be acknowledged in the spirit of particularly climate justice that's been alluded to previously. Thanks.
Thank you, Ansetse. I see your hand up, Jörg. Would you like to respond to that as well?
Yeah, also a little further on that question. I mean, if our proposal, our DRGR proposal, were executed, were adopted by the world's governments, it would correspond to some significant amount of real reduction, real enhancement of fiscal space. So it would be the equivalent in some way of a significant push in kind of grant finance. So in that sense, it's completely consistent with the impetus of your question in that sense. But yeah, I think we all would also agree with the need to provide much more climate finance as grants. But the debt relief moment in itself is a moment of very considerable. I mean, if you add up the numbers of billions, it's a significant amount of debt relief that would, is equivalent to a significant grant finance push.
Thank you, Jörg. I see other questions. For example, one that I think is very pertinent here on the engagement side, how to connect this initiative with the June summit in Paris, and how do you see the DRGR initiative play out in that particular context? So who would like to answer to that question? Okay, Kevin. Okay, please go ahead.
Hi, we've been engaging a lot with the folks organizing the Paris Summit, which a lot is riding on it. Obviously, one of the core concerns of the Paris Summit is the rising cost of capital for mitigation and adaptation and climate resilient growth paths. So there is a lot of overlap here, and the leaders of the Paris Summit are very conscious of the fact that there's a growing number of countries that, even if all of the agenda items at the Paris Summit are delivered on, that will still be shut out of the capital markets in order to do it. One thing that's in our report that we argue for, which will be something that'll be argued for loud and clear in the Paris Summit, is a need to have state contingent liabilities in new bonds. So when we restructure the debt for all these countries, not only should the new bonds be linked to country-owned climate prosperity plans, nationally determined contributions, sustainable development plans, et cetera, sort of core spending plans, but they should also have contingencies. So if there is a travesty like what happened in Sri Lanka in 2004, what has happened last year in Pakistan and Nigeria and Durban, and which happens on a monthly basis in parts of the Caribbean, that countries aren't paying back loans at higher interest rates in the middle of crisis response. So that's one thing that you'll hear loud and clear at Paris that we have as a centerpiece of our proposal. And there's also a real acknowledgement of the need to bend down the cost of capital. And the whole conference itself in Paris is how to get us this mobilization of $1 trillion in external finance and another 1.3 in domestic finance each year in between now and 2030. This is one piece of that puzzle.
Thank you, definitely. Thank you, Kevin. I would take another question regarding the question reads, the need to have more detail on how this new debt relief framework will guide investment into green and inclusive areas, not only in climate, but also for biodiversity. And just to remind that the initiative is called Debt Relief for a Green and Inclusive Recovery. Of course, climate is a priority, but we cannot fix climate if we do not address the biodiversity and the extinction crisis or the water crisis altogether, that's for sure. Over to you, Uli.
Yeah, thank you. Actually, I should have talked a bit more about that previously. So the idea is that countries that get debt relief will then also put forward their own plans for green inclusive recovery. So drawing on existing national adaptation plans, SDG plans, and so on, they will put forward a plan on how to use the extra fiscal space they get because of the debt relief. And ideally, of course, this will be a process that will involve all stakeholders, including civil society and so on. But the idea is that countries put forward their own agenda. And so it's not the IMF that will come with some great ideas on how to reduce emissions or whatever. It should be the country's own development agenda or sustainable development agenda. And for this, of course, there should be then KPIs, so to have clear metrics on what should be achieved, and that in turn would actually also help to pave the ground to label these restructured bonds as sustainability-linked bonds. Yeah, so which is another small sweetener, because of course capital markets are increasingly paying attention to these issues, and that makes it also more attractive.
Well, thank you, Uli. There are more questions, and please feel free to contact us, to contact the project, the co-chairs. We'll be happy to respond to your questions. We took due note of the questions, and we will be, I think, able to respond to the questions in writing and come back to you. And thank you, because I see questions that have 3, 4, 5 likes, but we are very short of time. And in light of time, I fear that I will hand over to Shamshad Akhtar for some closing remarks. So you have the floor, dear Shamshad. You are on mute.
Okay, so thank you for passing the floor to me. To conclude this exchange is difficult, but let me reinforce findings and key features of our debt restructuring proposal without getting into the numbers and excessive technicalities. So the first point I'd like to mention, for those who think debt distress is not as severe as what it used to be during the HIPC or other, where HIPC was warranted, that we need to really look at the fact that public debt has soared during pandemic, and subsequently it has been rising because of back-to-back multiple crises, or what we call polycrisis. In midst of this, emerging market and developing economies, debt distress has deepened and penetrated, reaching 3.9 billion. That's the last number I will quote. And it's across over 60 countries that face climate vulnerabilities. The list is available in our report. EMD's debt remains elevated in 2022 as growth outlook remains weak. The rise in interest rates and the strong US dollar are adding to the borrowing cost, in turn weighing on growth and fueling financial stability risk. Debt distress of emerging market developing economies are drivers of global growth and trade economy, have created macroeconomic complications, and in some instances, depleted FX reserve, the case in point is Pakistan, and local currency depreciations. Cross-border spillover consequences of the emerging strains is evident as the world economy is today a highly integrated world. Gravity of the debt distress and its consequences has been a source of concern, but some quarters underplay it as negotiations are likely to end up being complex, protracted, and require haircuts that have been discussed. But they are unavoidable as we have. But the good thing is that the past precedent shows us the pathway that it is a doable approach. The second point I'd like to mention in conclusion is that high debt distress economies also face climate vulnerabilities, a topic we were discussing a while back. They are facing challenges to seek a sustainable debt relief that could offer resources and fiscal space to implement Sustainable Development Agenda 2030, and hence the Secretary General has asked for a 500 billion or so for the SDG agenda. And also we need phenomenal funding for climate mitigation and adaptation requirements and resilience. A third point I'd like to underscore is that DRGR proposal is structured to offer systemic approaches to resolve systemic debt crisis, but advocates it be anchored to promote a just transition to a sustainable low carbon economy in partnership with policymakers and international community. A fourth point, which has been underscored already quite a bit, is the G20's common framework for debt treatment. It has only delivered modest debt service suspension, MDB's enhanced policy-based lending, and IMF debt SDR issuance and allocation that did bolster FX reserves, along with other endeavors, fall short of the requirements and expectation as its geographical and creditor coverage was limited and not proportionate to the debt distress and climate vulnerabilities. Under the common framework, debtors countries have avoided declaring defaults because of political and market excess complexity, and also within it, the pricing concerns. The fifth point, DRG develops, as I pointed out, a systemic solution to tackle a systemic debt crisis. There is need for coordinated action to reform what has been pointed out by both Kevin and Uli for enhanced DSA, which was touched upon in our previous report, by enriching it with comprehensive surveillance that IMF conducts, factoring in risks and financing requirements for economic and climate vulnerabilities, while accounting for finance needed for sustainable and climate resilience. The chart that Uli had shown regarding how the public and private creditors interface would work, I believe requires fostering global partnership across multilateral, public and private creditors to allow for debt resolution to lift debt sustainability. So you can't be looking at different components separately, but you have to realize that there is a nexus and they have to hold each other together. Key challenge are, of course, acceptability by stakeholders of haircuts that would not jeopardize the MDB's creditor status and AAA ratings, because they have to provide more and more funding for the crisis, not only this, but the future ones that are to come. And also, will the haircuts and the complexities of it, how will they be incentivizing the private and commercial creditors? Because we do need the credit guarantee mechanisms and credit enhancement, which has been talked about. So new common framework that has been discussed in our report would be able to return countries to capital markets and stand with more capacity to absorb SDRs, hopefully more issuance of SDRs, new concessional loans and grants to close the finance gap. I close by the last point that our report is a contribution to the global thought process. There are several other reports that complement and sometimes contradict, but it's really for the those who are actually reviewing the international financial architecture to understand that our report is a part of the discussion, and we have to really raise the ambition, which remains muted. A fundamental debt relief and action that has global buy-in to promote sustainable, climate-friendly, and resilient growth is the need of the hour to really lift almost millions of people out of poverty and those that have been denied sustainable living and are living through a worse cost of living crisis. So we count on the global policy makers for absorbing our plan of action and, of course, reinforcing with what is required by the G20 to transform the global commons framework to accelerate and improve and bring in greater predictability, earlier engagement on a payment standstill, and further clarification on comparability of treatment. The role of MDBs, either through provision of net positive flows of concessional finance, as argued in the Global Roundtable, has to be a part of the scheme of things. Thank you, Maria.
Thank you, Shamshad, for highlighting these very critical points. 60 minutes are definitely very short for such a complex topic, but we hope you all enjoyed the discussion as much as we did. If you want to keep updated on the developments of the DRGR, please do subscribe to our newsletter. Thank you for your interest. Thank you for joining us this afternoon. Take care and goodbye. Thank you.